Welcome to the Deep Dive. We cut through the noise of complex sources to give you the clearest takeaways. Today, we're digging into the CarParts.com Q2 2025 earnings call. It dropped after hours back on August 12th.
Yeah, and this call landed at a really critical moment for them. Probably one of the most stressful calls they've had in years, actually.
Wait, so stressful?
Well, they were already right in the middle of this formal strategic review, basically exploring a sale or some kind of major investment. And on top of that, they were grappling with these huge sector-wide problems, collapsing margins, these brutal tariffs. It was a perfect storm, really. So the results they shared, they just sort of laid bare the tension between, maybe some operational progress and these massive external headwinds.
Okay, let's get right into the numbers that caused the immediate market jitters. Top line revenue actually looked okay at first glance.
Sort of, yeah. It landed at $151.9 million. That was up 5.3% year over year.
And it beat estimates, right? Just slightly.
It did, yeah. Consensus was around $150.6 million, so they edged that out. But nobody was really looking at the top line after the rest came out.
Right, because the anxiety came from profitability, or lack thereof.
Exactly. The bottom line was where things just fell apart. GAAP EPS, your standard earnings per share. It was a big miss.
How big?
A loss of 0.023 cents per share. The street was expecting a loss of only $0.16. So significantly worse.
And then the metric management really focuses on adjusted EBITDA. How did that look?
Also pretty bad. It deteriorated sharply. They reported an adjusted EBITDA loss of $3.1 million.
Okay, put that $3.1 million loss in context for us.
Well, just the year before, Q2 2024, they were almost break even on that metric. The loss was only like $0.1 million. So swinging from basically zero to a $3 million loss. I mean, that tells you the core operational profitability before interest and taxes and stuff really eroded fast.
So modest growth completely wiped out by margin pressure. That's the story.
The headline, yeah. The market reaction was all about that margin slip and the bigger GAAP loss. Forget the revenue beat.
Okay, let's dive into that margin pressure then. That seems to be the core problem. Gross margin fell. What was it?
It dropped to 32.8%. That was down from 33.5% the year before. Not a huge percentage drop on its own, but really significant given the context.
And management pointed to two main culprits.
Yep, they were pretty clear. Mix shift was one, meaning the blend of products they sold wasn't as profitable. And the second, the really big one, was these persistent tariff pressures.
Tariffs have been a theme for a while in this sector. Did they give specifics?
They did, and it really highlights the scale of the problem. They mention products from Taiwan face a 25% tariff. Okay, high, but maybe manageable. But then auto parts coming from China, the rates they're facing are between 55% and, get this, 75%.
Wow, 75% on your cost of goods.
Yeah, I mean, how do you even operate? You can't just pass that kind of cost increase onto price-sensitive online shoppers.
No way, you lose all your customers instantly.
Exactly, so you have to eat most of it. And that just crushes your gross margin. It's brutal.
And this environment, these insane tariffs that led directly to a pretty drastic move on the call, right? What called the big pause.
That's right. They explicitly withheld full year 2025 guidance, just pulled it completely.
Which is a huge signal to the market. What was the reasoning tied to the strategic review?
They basically said, look, we're in this process. Evaluating strategic alternatives could be a sale, could be a big investment. And right now, our priority has to be maximizing our leverage in those talks, shoring up the balance sheet, finding the right partner. That took precedence over trying to predict Q3 or Q4 numbers for Wall Street. Giving guidance just wasn't the focus.
Okay, so margins collapsing, guidance paused. Makes sense. The next question is liquidity. Did they have enough cash to weather this storm, especially with that strategic review potentially dragging on?
They ended the quarter with $19.8 million in cash on hand. What was interesting, though, is they noted they'd proactively drawn down on their revolver, their credit line, during the quarter.
Okay, was that a sign of distress or something else?
Yeah. Management framed it as being prudent, building a buffer. When you see 75% tariffs possibly hitting more of your inventory and you're in strategic talks, having extra cash ready makes sense.
Right, for inventory for potential disruptions.
Exactly. They also mentioned inventory was up a bit to $94 million from about $90 million at the end of 2024, partly because they were trying to buy some things ahead of tariff hikes.
That risky inventory.
They specifically said it had low obsolescence risk, so mostly staple products they expect to sell through.
Okay, so they played defense with cash, but what about offense? What were they doing internally to fight back against these pressures? Any concrete cost actions?
Yes, they announced some pretty significant cost-cutting measures. They were aiming for about $10 million in annualized savings.
$10 million. How are they planning to get there?
The biggest piece was closing their distribution center in Virginia. That was set to happen by the end of August.
Why close a DC?
They said their big, newer facility out in Las Vegas was proving so efficient, it basically created excess capacity across their network. So the Virginia site became redundant. On top of that, they mentioned streamlining some corporate headcount and cutting back on non-critical software spend, partly by using more AI and automation.
So facility closure, headcount tweaks, software cuts, adding up to that $10 million headline figure. How did the market react to that? Was it seen as enough?
I think the reaction was necessary, but probably not sufficient on its own. I mean, $10 million is real money, definitely helps stabilize things. But like you said earlier, is $10 million in savings really going to offset a 75% tariff hit across a big chunk of your products? Probably not entirely. It felt more like a defensive move while they sought a bigger strategic solution.
Right. But amidst all this defensive maneuvering, they did try to highlight some positives, some green shoots, indicating the underlying business wasn't totally broken.
Definitely. They wanted to show there was still momentum, especially in building direct customer relationships. That's the long-term story they're trying to protect.
So what were those bright spots?
Well, first, mobile app adoption. They hit over 1 million cumulative downloads, which is great. And the app now drives 12% of their direct e-commerce revenue.
Which is important because it's their channel, right?
Right.
Lower cost than marketplaces.
Exactly. More control, better margin potential. Second, they talked about their paid membership programs, Car Parts Plus, and the roadside assistance offering.
How are those doing?
They crossed 7,000 paid members. Now, that's still relatively small, but it's high margin recurring revenue. It shows customers are willing to pay for added value, which is a good sign.
And there was one other specific data point they shared, just or a single month, that painted a slightly different picture than the overall quarterly loss.
Ah, yes. Very important. They made sure to point out that they did achieve positive adjusted EBITDA just for the month of June.
Okay, why single out June?
It was a signal. It suggested that, strip away some of the timing noise or maybe the worst of the tariff impact averaged over the whole quarter. And their core operational improvements, the cost cuts starting to bite, the marketing efficiencies that could actually deliver profitability, it showed the potential was still there.
So internal efforts, showing some promise. But externally, one area they seemed to be, retreating from was marketplaces. Like Amazon or eBay, presumably?
Yeah, they were pretty blunt about that. They talked about a race to the bottom on those third-party platforms.
What do you mean by that?
They pointed to a flood of lower quality, often non-compliant parts, especially cheap imports from China, that just distort pricing and make it impossible to compete fairly if you're selling compliant quality products.
So their response is?
To pull back from that mud, as they put it, and double down on their own site, carparts.com. Focus on their own brands, control the customer experience, ensure quality and compliance. Basically, trying to build a brand moat away from the pure price wars.
Okay, so that paints the picture from the Q2 call. Margin pain, tariff pressure, some cost cuts, trying to build their own channel. But then things changed pretty quickly after the call, right? The strategic review reached a conclusion.
Exactly. The Q2 call was really about diagnosing the illness. The cure, or at least the proposed cure, came about a month later on September 9th.
That's when the strategic investment was announced.
Yes. And it wasn't just any investment. It seemed tailor-made to address the specific problems laid out in that Q2 call. It completely reshaped the narrative.
How much was the investment and who was involved?
It was significant. $35.7 million in new equity, priced at $1.04 per share, plus another $25 million in convertible notes debt that can turn into stock later at a 2% interest rate and a $1.20 conversion price.
Okay, so substantial capital. But you said it was more than just money.
Absolutely. The who is crucial. The investors were industry players, ZongTeng, A Premium, and CDH. This wasn't just financial capital, it was strategic operational capital. Partner power, like you said.
And how does this partner power directly address the margin and tariff problems from Q2?
It hits them head on. A Premium is a parts supplier. The deal promised to bring over 150,000 of their products onto carparts.com. So boom, much wider assortment, potentially better sourcing costs on those parts. And ZongTeng. They're a major logistics and fulfillment player, especially with cross-border e-commerce. Accessing their network offers the potential for, faster and crucially cheaper fulfillment and shipping.
Ah, so attacking both the cost of goods side and the shipping cost side, which were likely both hurting margins.
Precisely. It's like buying a competitive supply chain and logistics network that they probably couldn't have afforded to build themselves, especially not quickly.
So the whole narrative shifts. They go from being this standalone e-commerce site battling tariffs alone to potentially being a much more integrated platform partnered with major suppliers and logistics operators.
That's the pivot, exactly. The focus for anyone watching now shifts completely to execution and integration.
What should investors be looking for as proof this partnership is working?
Tangible results. You need to see updates on integrating premium's products. Are they selling? Are they improving basket size? And critically, evidence of actual logistics savings coming from the ZongTeng partnership. That needs to show up in the gross margin and shipping cost lines.
Can they translate this strategic leverage into better unit economics and ultimately consistent, positive, adjusted EBITDA?
Yeah.
That's the key question now.
That's the billion-dollar question, or maybe the $60 million question in this case.
All right, this transition leads us perfectly into our segment. This is not financial advice. We've got this fascinating disconnect. Terrible Q2 results, tanking the stock, followed almost immediately by smart money stepping in at higher prices. What's an outrageous but plausible trade idea here?
Okay, so disclaimer firmly in place. This is just spitballing based on the info. But the trade idea is to go long carparts.com.
Long after that Q2 print.
Yes, but the thesis isn't based on Q2. It's based entirely on the subsequent strategic investment acting as both a valuation floor and a catalyst.
Explain that floor concept. How does the investment create it?
Look at the sequence. Q2 earnings come out. Market absolutely freaks out. Stock plummets to, dollars and 77 cents a share. Retail sentiment is basically, this company's doomed. But just a few weeks later, you have these sophisticated strategic investors who've done deep due diligence, seen the non-public data, understood the ZongTeng potential. They come in and inject equity at $1.04 per share.
Okay.
And maybe even more telling, they structure the $25 million in notes to convert to equity at $1.20 per share. That implies they see a credible path for the stock to get above $1.20 for their debt investment to become more valuable as equity.
So the institutions are betting on a turnaround price well above where the market panic took the stock.
That's the interpretation. The market saw the Q2 problem. The institutions bought into the partnership solution at prices significantly higher than the post-earnings low. That $1.04 equity price acts as a potential psychological floor validated by informed capital.
So the trade is basically betting that the partnership works as planned.
Pretty much. Your betting management executes on those $10 million in cost cuts they promised, and that the ZongTeng premium integrations start showing real benefits to margin and logistics costs fairly quickly.
Okay, so entry, target, stop loss.
Based on this thesis, you'd look to enter long somewhere around that $1.04 institutional equity price, maybe slightly above. Your near-term target would be that $1.20 convertible note conversion price. That's a clear level the debt investors are anchored to.
And the stop loss.
You'd probably set a tight stop just below that $1.04 level. If it breaks convincingly below the price the strategic partners just paid, your thesis is likely challenged. It's a play purely on the partnership execution validating those investment prices.
That is definitely an outrageous but plausible read, focusing entirely on the post-earnings strategic pivot. Okay, let's recap this deep dive on carparts.com. Q2 was rough, defined by those margin pressures, the tariff headwinds, leading to that negative $3.1 million adjusted EBITDA. Real pain.
But almost immediately overshadowed by the announcement of the strategic partnership with ZongTeng, Premium, and CDH. That deal directly targets the core problems, fulfillment costs, tariffs, product assortment identified in the Q2 call.
So the company bought itself time, capital, and potentially a much more competitive operating model.
Exactly. And the key question for you, the listener, to mull over is this. Can that promised $10 million in cost savings, plus the operational leverage from these new partners, be enough to quickly and sustainably push them past that $3.1 million quarterly adjusted EBITDA loss they just printed?
That really is the crux of it for the next few quarters.
That's the hurdle they need to clear.
Indeed. And just a final reminder, everything discussed here is for informational purposes only. We're analyzing public statements, not giving investment advice. Thanks for joining us for this deep dive.